Good morning, everybody. My name is Alan Babcock. I'm the Vice President of Strategic Partnerships with Leverage and the League of Southeastern Credit Unions. And I'd like to thank you for spending a little bit of your time this morning to attend this webinar on the employee retention credits. Our presenters today are from Synergi Partners, a company with over 40 years of experience in tax credits incentives. They're currently working with a number of credit unions. And in fact, LSCU is engaged with Synergi Partners to review our opportunities for the tax credits as well. So we feel that they are uniquely qualified to do this presentation today. As a matter of housekeeping, please keep your phones on mute unless you're going to ask a question. Or if you prefer, if you look to the bottom of your screen, you'll see a Q&A tab. Please feel free to add any questions in there. We'll be monitoring that and make sure the presenters have those questions as well. So now it's my pleasure to turn the presentation over to Tom Godfrey, the National Sales Manager, and Brad Marcus, the Head of Financial Institutions Alliances with Synergi Partners. Gentlemen, it's all yours.
Thanks, Alan. Yeah, good morning, everybody. I'm Tom Godfrey with Synergi Partners. Looking forward to sharing the information with you today on the employee retention credit. Got a presentation I'm going to walk you through. Before I do that, it's my pleasure to introduce you to my teammate, Brad Marcus.
Good morning, everybody. As Alan said, we're thrilled that you're here. We are going to go through a slideshow that I hope you will find informative. Again, we look forward to the Q&A session. It's where Tom and I have the opportunity to drill down. But don't worry if your question hasn't been answered. It's all about the follow-up, and Tom and I will be in touch with you. I've been with our firm for about 18 months after 4 decades in the in the industry on your side of the desk. And I'm thrilled to be joining today. Thanks so much. And Tom, I'm going to turn it back to you.
Thanks, Brad. So what I'm going to do is I'm going to share with you just very briefly about who we are. Then I'll walk you through the credit, kind of explain the history of it, explain how it works, then give you a good feel for the size of the credit that you could expect for us to deliver to you, and then walk you through the specific reasons of why credit unions qualify for the employee retention credit. And then how the process works with us. I've had the pleasure now, I've also been with Synergi about the same amount of time as Brad has. I've had the pleasure now of helping close to 700 companies with this credit, and out of that, several dozen credit unions. So certainly looking forward to sharing the info with you. So Synergi Partners, we are the largest privately held tax credit service provider in the country. And this is our leadership team. You know, they're really the driving force behind our success. Our founder and CEO, Jim Brown, not an understatement at all. He's been one of the most influential people in the U.S. in the world of tax credits for almost 45 years. And that's because Jim's entire career, he's worked very closely with Congress. And so over that span of time, he's played a key role in helping Congress and working with them to pass important tax credit legislation. Really what's important for today's meeting is that Jim and also our primary outside counsel, his name is Evan Migdale. He's a senior partner with DLE Piper in DC. They've worked together for over 30 years. They're both advisors to the House and Ways Means Committee. So they were there. They attended all the meetings last year during the drafting of the CARES Act, and both provided input during those meetings that helped to author the employee retention credit. We've also got a couple of members of an internal government relations team. So between them, Jim and Evan, we're talking to folks on the Hill regularly every month. So very long way of saying we know this credit exceptionally well. And that, of course, is what gives our clients tremendous confidence in our guidance. As far as our clients, you know, we do have clients nationwide, clients of all sizes, certainly a lot of clients in the financial services sector. Altogether, our clients employ over 3 million Americans. But one of the great things about working with us is we're not a behemoth, because out of those 3 million Americans, there are about 100 really big companies. Many of them you would know well, but the vast majority of our clients are like you. They typically have anywhere from 20 up to a couple hundred employees. And we have almost 450 of our teammates here at Synergi. So we do have an excellent client service to client ratio. Another great thing about working with us, you'll never have to call into a call center. You'll have a dedicated tax service manager, so it is a one-on-one relationship. There are many reasons why our clients partner with us. Really, the top two are, one, we help our clients to maximize this credit. All tax credits have nuances. This one absolutely has its fair share. Not to worry, we know those nuances, so we will get you every available penny. But really the most important reason why our clients partner with us is that last chevron there. So audit support has two components to it. The first is that the documents that we will provide to you, they're called tax credit packages. We'll give you one for each quarter going back to Q2 last year in most cases. And Brad's going to explain what I mean on that. They are audit defensible documents. The other part to audit support, it is very rare, but if any of our clients are ever audited by the IRS for any tax credit that we help them with, then included in our service at no additional fee, we provide full legal defense on their behalf against the IRS. And I'm very happy to report this morning that over the course of almost 40 years of business, we have never lost to the IRS. We haven't had a single penny overturned upon audit. So a lot of reasons for that. I think the most important is that we do have financial stake in this with you, because it states clearly in our service agreement that if you are ever audited for the employee retention credit, and we actually lose to the IRS for the first time, we have to refund you our fees for whatever credits that they overturn. So needless to say, we are highly invested in keeping our clients protected. And at the end of the day, we always validate our clients' eligibility. Then we move forward and capture the credit for them. All right, so let's talk about the employee retention credit. So both the PPP loans and this credit were made available on the same day last year. That was March 27th when the CARES Act was enacted. Of course, last year, employers could not take both. They had to make a choice. Fortunately, that all changed on December 28th when Congress passed the second round of the CARES Act and said, hey, good news, you can now take both. The rule they put in place for that is that you can't double dip there. We realized that, of course, you yourselves did not take the PPP loan, but you certainly helped a lot of your clients with that. The other thing is that, I always like to give folks a friendly reminder that if you partner with us on the employee retention credit, you absolutely will not be testing the waters on something new. It's been around for 19 months, and that's why we've got well over 6,000 clients that we're currently helping with the ERC. Now, part of the reason for that is last year, companies that had over 500 employees could not take the PPP loan. And I'm sure, as you know, there were a couple of exceptions to that rule, like restaurant chains, car dealerships, but most companies that size could not. So that's why last year we brought on a lot of very big customers for this credit. And it's interesting, if you look just at the Fortune 1000 alone, well over half of them, they wasted no time. They started using this credit very early on last year. So definitely not a new credit. Then as far as the comparison here, again, we realize you did not take the PPP loan, but it's still good to know they really are polar opposites. The PPP on the one hand, really the big thing is it was public information. Whereas the employee retention credit, if the business is private, it's a completely private matter. The other thing is, since day one, this credit's been available to companies of any size. So you could have one employee or you could be Walmart, makes no difference. And as far as the process, the way it works with the ERC is you do, of course, need to qualify. And that's where we come in. We will thoroughly document your eligibility. We're going to talk through that here in a couple of minutes. We will also calculate the credit for you. The way that it's monetized is on the quarterly 941 payroll return. Most of our clients are with a payroll service. So the way it works is we give the amount of the credit to you for each applicable quarter. You then provide those amounts to them, and they will file this for you on amended 941 returns. It's a form called the 941X. Of course, if you do your own payroll in-house, then we'll give you those instructions on how to do that. You'll file those. If for any reason you don't want your payroll company to do that, or don't want to do those on your own, that's fine. We do have an excellent partner firm that will be happy to file those amended 941s for you at a very reasonable cost, and they'll get it done quickly. Ultimately, the way this has worked since inception is when the 941 arrives at the IRS, the ERC is deemed eligible upon arrival. But it is the IRS. So if the amount on the 941 does not look accurate, they will pull the 941 and review it. That's not an audit, but it's certainly not something anyone wants to deal with. So there again, it's another really big reason why our clients partner with us, because we will absolutely calculate the credit correctly for you to the penny, which means the IRS will approve your 941s and issue these payments to you. These are actual payments they send you. And since this is obviously a different process from the PPP, number one, that means, hey, you're approved. There are no follow-up questions from anyone. And then two, when you receive these funds, you can spend them wherever you want within the business. So, obviously that's a little more flexible than the requirements of PPP. All right, so there really are three main components to the CARES Act that are relevant to payroll shown here. For anyone on the call that you utilized or took advantage of the FFCRA shown on the left, which was available last year through the end of Q3 this year, that's great. Just know that that is also a tax credit. You can't double dip on the same wages with two different types of tax credits. So it's bad news, good news. The bad news is we do have to remove those wages from the calculation of the ERC. The good news is it's a really small dollar amount, so it really has a nominal impact. As far as the employee retention credit, it is unique. That's because all other tax credits are below the line. They're refundable against income tax. Whereas the ERC, and this was also true of the FFCRA, they were the first ever in US history above the line credits because they're refundable against payroll tax. The ERC is specifically refundable against your FICA wages, so 15.2%. And when you receive the payments from the IRS, they are truly above the line. They're a part of your EBITDA. They're not even considered income. They're considered cash. The reason for that is these payments are, of course, reimbursement for the applicable taxes, but they actually also include cash on top. It may sound a little strange, but it'll make sense here in a couple of minutes when I walk you through the calculation. By the way, one of the reasons why Congress structured the ERC the way that they did last year, you may have guessed it, is so that also nonprofits can use this. It's the first time in history that nonprofits get a credit. So with that, let's talk about how your credit is calculated. The way that you're going to qualify for the ERC, the rules really are about the same in both years, but the calculation of this credit is very different between the 2 years. So in 2020, and this is where it's applicable, and Brad's going to expand on this, for some credit unions, you do have the ability to get up to $5,000 per employee. And that is the case if you employed 100 or less full-time employees over the average of the 12 months in 2019. And the way that credit is calculated for 2020, if that was the case for you, if you had 100 or less, it's that second orange dot down there under the ERC. So the period of time that it is captured in 2020 is on your payroll wages from March 13th through December 31st. That's 9.5 months. And again, if you had 100 or less full-time employees in 2019, then the credit is calculated using those figures there. So 50% of the gross wages up to a cap of $10,000 per employee, which of course is a max possible credit of $5,000 per employee in 2020. Now, if you had over 100 full-time employees in 2019, the credit is calculated differently. Basically, you get partial, it's based on partial wages. And really the size in 2020, it's more around an average of about $2,000 per employee. So either way you get credit, you just get more if you averaged 100 or less full-time employees in 2019. So again, there are different rules depending on whether you are a federally chartered or state chartered credit union, and I'll let Brad walk you through that.
So as Tom articulated, there are many reasons why to do business with Synergi Partners, but one of them is reflective in this slide. So clearly in your industry, they're both federally chartered and state chartered credit unions, and that is a driver to eligibility. One of the things we do at Synergi Partners is regularly have discussions, as Tom's articulated, with the Treasury Department, congressional members, parties within the IRS to make certain that everything we're doing with Synergi Partners, as Tom's articulated, is right down the center of the plate. Hence, a recent change that we've made within Synergi Partners is we've done some extensive work around government instrumentality, and for federally chartered credit unions, we're going to proceed with processing the credit for 2021 exclusively, because as of the end of December, as Tom articulated, and with the also change that was in the first quarter of 2021, all parties have 100% agreed that credit unions are absolutely, if they're eligible to be considered for this credit within 2021, where federally chartered credit unions was a bit of a debate in 2020. No change at all for state chartered credit unions, eligible to be considered for the credit both in 2020 and in 2021. Having processed over 200 approximate credit unions, we're very familiar with all aspects of this legislation. We stand 100% behind our previous work to this point, but just wanted you to know that on a go-forward basis, one of the technical adjustments that we've made at Synergi Partners to make certain that we're working on your behalf with the highest regard. Go ahead, Tom.
Okay, thanks, Brad. So with that, let's talk about 21. So for those that are eligible for 2020, you know, $5,000, potentially up to $5,000 per employee certainly is not bad. But the size of this credit increased significantly in 21. And what happened is December 28th, Congress passed the second round of the CARES Act. On that date, they extended the ERC for 6 months through the end of June this year. However, you may recall it wasn't long after that on March 11th, Congress passed the American Rescue Plan. And part of that is they extended the employee retention credit again through the end of this year. However, there was another change recently, which was last Friday. Congress passed the infrastructure bill, and part of that is they backed it up. So now, as of today, the employee retention credit is available this year on wages through the end of Q3. However, there is another change in the works, and that is the reconciliation bill. We are confident that it is going to be passed. If it is, then what the reconciliation bill is going to do is put Q4 back in place for this credit, and even potentially Q1 next year. So as of today, the credit is available on your wages through the end of Q3 this year, but we are confident that's going to change and you will be able to get Q4 and Q1. So stay tuned on that. As far as the calculation of the credit, as I said before, it increased dramatically. And another really big thing that took place on December 28th is for this year, Congress got rid of that over under 100 employee rule, which was based on your head count in 2019. This year, they raised it to 500. So what that means is if you averaged 500 full-time employees or less over the 12 months of 2019, then this year, for sure, it's a straight calculation on your gross wages, as opposed to partial wages, which was the case if you had over 100 full-time employees in 2019. And so that calculation, 70% of the gross wages up to the cap of 10,000, but this time it's per quarter. So last year it was 50% up to 10,000 for 9.5 months. This year it's 70% up to 10,000 per quarter. So if you want to do some kind of quick back of the napkin math, basically everybody that's working for you that makes 40,000 a year or more, and of course that includes all earnings like bonuses, overtime, etc. That's 10,000 or more per quarter. That's a credit that you'll receive of $7,000, the max credit on each one of those employees. And of course, if they make less than 40, you'll get 70% of whatever their wages are. So you add those two together, and this is a sizable credit. And it's also a shocking number. I've had the pleasure of, again, helping close to 700 companies with this, many credit unions. Every single meeting that we have, this is an absolutely shocking number. And the reason why is it's the largest tax credit ever awarded in U.S. history. Nothing holds a candle to it. The intent of this legislation is right there in the name. So first and foremost, this is a stimulus to help you retain your current employees. But there's another purpose to this right alongside it. This is actually one of Congress's main solutions to the labor shortage problem. So the really nice thing about this, though, since you are familiar, obviously more than familiar with the structure of PPP, you know, the PPP loans had a lot of follow-up questions about retention. It's not the case with this credit. And so that is why at the end of the day, when you receive these funds, you can spend this however you want within the organization. So if you want to use it to hire people, great, but you don't have to. The other thing here too, it probably didn't take you very long to figure out that the size of the credit each quarter this year is significantly more than the FICA taxes that you're being reimbursed for. And so that's not by mistake. Congress did this so that you can get more cash on top. So basically how this works is when you receive these funds from the IRS, again, there's a separate payment for each quarter. Part of those funds will be the FICA taxes that you're being reimbursed for, but the rest is cash on top. And the way that this is treated is the ERC payments themselves are not taxable. So that is the one thing that this credit does have in common with the PPP loans. Where this is different is it is a taxable event. It's called wage add back. In essence, what you're doing is you're reducing payroll expenses that you would use to offset tax liability. But hey, that's okay, because again, if you have ever worked in an industry where you are familiar with below the line credits and that are refundable against income tax, this obviously is a lot more lucrative. Brad, is there anything you would add to that as far as how this is treated in the books?
So again, I would just say that, you know, we'll talk about this in more detail as we have a chance to share around your specifics. But again, as Tom's articulated, a portion of the refund that you would be receiving would be a direct accounting offset against the withholding that you paid. And as a non-taxpayer, the additional funds would be another form of income. And the reconciliation will, again, depending on when you actually receive the funds from the IRS.
Okay, thanks, Brad. And here are just a couple of examples of what the size of the credit can look like. So certainly nothing to sneeze at, and a terrific opportunity to help you again, not only keep your current employees, but to continue to grow the business. So with that, let's talk about how you qualify. So eligibility for the ERC is measured by quarter. Therefore, we will document this for you for all 4 quarters last year, right? If you are a state chartered credit union, and then absolutely for each applicable quarter this year for whether you're state or federally chartered. And as you can see, there's 2 very different pathways to qualification each quarter. The box on the right, that's called the gross receipts test. The nice thing about it, it's very straightforward. Problem with it, it doesn't help most folks. Out of all of our clients, only about 10% of them have qualified in any given quarter via that pathway. And typically it's hospitality, right? Restaurants, hotels, that's usually where we see it. We certainly don't see it for our credit union clients because most of their revenues have gone up. But that's okay. Don't worry about it, because we can tell you with an absolute certainty, you will qualify the other way. And it's called the government orders test. And as you can see here, it's defined as full or partial suspension of operations during the quarter due to orders from an appropriate governmental authority, limiting commerce, travel, or group meetings due to COVID-19. Let me break that down for you. Full suspension is exactly what it sounds like. So that's closure. And the rules of aggregation apply here. So what that means is if a business has just one location that is closed for 1 day or more, and the employees at that location do not work during that time frame, the entire business qualifies for that quarter. So we certainly have credit unions that have had experienced that, right? Where locations have been closed for a period of time. But most companies in America have not experienced that. And that's because over 80% of companies in America were deemed essential. However, what has happened to most folks is partial suspension. So if you've never been closed, that's okay, because what you absolutely have been experiencing since March last year, and in the majority of cases, through today, is partial suspension. Because what the term means is you're open, but the way that you operate has been, and in most cases continues to be, disrupted or limited by government orders. Now, the next slide, I'm going to walk you through a couple of examples of partial suspension. Before I do that, there's really three key parts of this legislation to take note of. The first is that the rules of aggregation also apply to partial suspension. Only needs to happen at one of your locations. All locations qualify. Now, the reality is it is happening at all locations, but it's still good to know that. The second part is an appropriate governmental authority. So that means orders from the Fed, state, and local levels. And then the final part is the word limiting. When we share this with folks, typically the question that we get is, hey, you know what, this makes sense, but how do you quantify this, right? How do you measure partial suspension? And the answer, fortunately, is there is no measuring stick. When Congress wrote the ERC legislation last year, they wrote it in 9 days during the middle of a national crisis. And they intentionally wrote it so that businesses do not have to quantify their partial suspension. Another way of saying that is Congress measures partial suspension by starting and stopping with the word limiting. In tax credit language, that's as broad as it gets, and that was not by mistake. The reason for that is they stated clearly during the drafting of this, and they still hold true to this today, their intent is that most companies in America can qualify for this. And that is why they've left the doorway to eligibility very wide open. If they had wanted to, they could have easily made this difficult to qualify for. They could have said just full suspension and stopped there. Or they could have taken it a step further and said full or partial suspension limited by some type of measurement. They didn't do that. So what is partial suspension? Well, here you go. I'm gonna turn this over to Mr. Marcus to kind of walk you guys through this.
So obviously this slide is just to articulate just a few examples that we've seen from many of the credit unions that we've worked with. So starting with the top left, branch or lobby closures, as Tom talked about, whether they were specific to a COVID outbreak from one of your employees, or whether you had to close because one of your members may have come in and exposed your employees to the process. Back to the top right, branch access restricted. Many credit unions had to go to appointment only for some portion of a period of time. A branch service is limited to drive-through only. For your branches that have drive-through, many credit unions chose to do the majority of their operations through drive-through, and in some cases we're using it for intended things that were well beyond what the original scope of what you would have used a drive-through again back in 2019. Suspension to in-person business development and community outreach is a huge one for your industry. Credit unions are all about their communities, whether it's outreach to the entire community or whether you're focused on segs, sponsorships, development, all of those things were essentially shut down, and many have slowly come back now in June of this year. Again, all facts and circumstances that we would discuss with you. Most credit unions have historically attended some kind of travel. As Tom articulated, the word travel was specifically mentioned in the legislation. And so if you had historically gone to a league meeting or another industry conference and you did not, there's another example of something that we would document on your behalf. The rest of the ones are limited here, but I'll again pay special attention to the fact that for many times you would have had employees that either directly had COVID or had family members that had COVID. And obviously that's one that was extremely impactful on your business, no matter when it occurred.
Thanks, Brad. And what we do is we have a database of all government orders, fed, state, and local. And so your first meeting with your dedicated tax service manager is all about walking through a list of questions around eligibility. And typically, they can gather all the information that they need from you in that one meeting. If not, there'll be a follow-up call. But you basically share with us for each quarter your information on how your operations have been impacted. But you certainly don't have to tell us about government orders. That's our job, right? So when we send your tax credit package to you for each quarter, of course, it's going to show the credit that we captured and then down to the employee level detail on how it was calculated. But we will also provide you with an eligibility statement, and that's the audit defensible document. And it will have numerous government orders that have impacted your operations and a thorough narrative on that detail. So probably no surprise to you, depending on the state, early on last year, there were certainly state orders in play, and in a lot of states, there were orders in play this year, Q1 and Q2. And there still are some states where that's the case. But a lot of this actually is from the federal level. There's a very small part from the CDC. Most of this, though, is due to numerous orders for COVID-19 from OSHA. Those orders have been in force since March last year, and they're still in force today. And that's why most folks are continuing to qualify for this, right? Because you have to follow those orders or you will be heavily fined, and they certainly are limiting the way that you do business. But again, I think you'll be surprised. A lot of clients are surprised at how thorough this is, and some of the things that we include that maybe they've forgotten about. Like, for example, the second one down from the bottom on the right. That certainly was big last year. Most of our clients had employees that were not able to work for a period of time because the schools were closed and they had to stay home and take care of their kids, right? So again, those are state level orders that impacted your operations. So if we listed every single order that has impacted our clients, we would inundate them with hundreds of pages of orders. So don't worry, we're not going to do that. But it will be very thorough. It's usually anywhere from about 40 to 100 pages of orders and commentary on how you qualified. And this is exactly how credit unions qualify for the employee retention credit. So another question that we get a lot, not just from credit union clients, but folks in other industries, there are many where revenues have gone up compared to 2019. Whether it's 2020 compared to 19 or 2021 compared to 19. Well, that's okay. Congress took this into account, and they wrote this legislation exactly the way that they did, so that the direction of a business's revenue, the only time that it's relevant is if it dropped enough that the employer qualifies that quarter via the gross receipts test, the one on the right. But for the government orders test, the direction of a business's revenue is irrelevant. It's not even factored into the conversation. The only thing that matters are the impact to your operations from government orders. And therein lies the reason why we have a lot of clients whose revenues have gone up, but they still easily qualify because of the impact of their operations. Now, they're not a credit union, but I'll give you an example of one of those Fortune 1000 companies that really set the benchmark for this. Everybody knows them, and that's Best Buy. They're not our client, but they're public, so we have looked at their 10Qs. Best Buy, when it's all said and done, they will have received over $300 million in this credit, and 2020 was their best revenue year in company history. So again, revenue is not looked at for this. It's about the impact to your operations. And of course, those orders have cost Best Buy tens of millions of dollars. So it's really all about not the fact that your revenues went up, it's how much more could they have gone up if it was not for these orders. All right, so with that, let's talk about the process. So anyone on the call, obviously, if you're interested in exploring this further, just let us know, and we'll be happy to send you a proposal and also a service agreement so that you can evaluate that. And then certainly if you want to have a follow-up meeting to discuss more details, we'll certainly do that. The way the process works after the agreement is signed is there are 2 follow-up emails that I'll send you as next steps. The first one will have a couple of questionnaire documents, promise you should not take you any more than 2 hours to complete those. It's really kind of prelim questions so that your tax service manager can read those before they meet with you. And so that would be the first step. Is you complete those, you send those to me. I then forward them to my team, and within a day or two, they'll send you an email. And in that email, there will be a secure portal that you'll use to upload your payroll file to us. That's the second email that I will send you. It will clearly explain how we need your payroll file. We've got clients with all kinds of different payroll companies and different platforms. So part of the information you'll provide in those first set of documents is you'll let us know who your payroll provider is or your in-house software. And we've got enough feedback from clients to be able to give you good guidance on where to go within that payroll services platform to at least get started and put together the file. And then again, depending on the time frame, right, you'll send us the payroll file. Once we receive that from you, your dedicated tax service manager will schedule your welcome call. And then depending on the size, as far as how many employees you have, if you had 100 or less full-time employees in 2019, then for you, again, it's payroll analysis, as you see here at the top. And typically your tax service manager is only going to need no more than 3 meetings. That's it. They're anywhere from an hour to 30 minutes. That's all the time that we need. And that gives us what we need to be able to deliver the credit to you. Now, if you had over 100 full-time employees in 2019, and you are a state chartered credit union, then we will also perform what is called a work task study, and that would be for 2020. Just to keep it simple, this is a proprietary process where we would get you additional credit in 2020. And either way, whether if you had over 100 in 2019, typically you're looking at 3 to 4 meetings with your tax service manager. But again, good news is this is not a software install. It's really a small amount of time for the return on investment. From the date that we receive the payroll file, we will deliver your credits to you within an average of 12 weeks. And then once you receive those from us, you will file this and monetize this on the amended 941 returns, whether that's through your payroll service or on your own or through our partner firm. Once the IRS receives those, their current turnaround time to send these payments, the average turnaround time is 16 weeks. So let's say you start in December, you send your payroll file to us in December, then you'll be looking to receive your first round of payments this coming summer, call it June, July. By the way, 16 weeks may sound like a long time for the IRS. They have dramatically improved. If you go back to Q1 this year, it was taking them about 20 to 24 weeks. And the reason why they've been able to significantly improve on that process is about 3 months ago, Congress allocated $2.5 billion to the IRS. And a big reason for that was to help them speed up these processing times. So again, they would send these payments to you. They are above the line, and you can spend the money wherever you wish within the credit union. So that is the process. And then the last part is, how do our fees work? So everything that we do for our clients is success fee based. So of course that means no money up front of any kind. It's also a great business model for both parties. We receive a percentage of what we capture. So we are highly incentivized to make sure that we don't leave a penny on the table. And then when your tax credit packages are ready, your tax service manager is going to have a meeting with you to review them. We won't send out your invoice until the following day. What we typically charge for this service and for a host of other tax credits that we help with in the for-profit sector is a success fee of 20% on whatever we calculate or capture. But through our partnership with Katie and her team at One Digital and also the folks at Leverage, you guys are receiving a discounted rate of 25% off of that. So it's a success fee of only 15%. And that, ladies and gentlemen, is the presentation. So just let us know what questions that you have at this point.
Hey, Tom, do you have, are you able to show that last slide that shows the the leverage URL link to allow the credit unions to follow up directly with you and to just show how they will engage with you, because I think that's important. And then while you do that, I did get a question in the Q&A. I'm not sure it's been completely addressed or not, so I'm going to let you and Brad kick this one around. The question reads, we recently approached our CPA about this, and there seems to be some concern that this is not permissible. Can you shed some light on the specific IRS rules that will allow this?
Sure, I'll take that on, Tom. So again, without knowing the specificity of what your actual CPA was focused on, I'll have to give a general answer. There are several things that we hear. One that we hear largely is that credit unions are not eligible at all because they were essential businesses. Synergi Partners, through actual engagement with the IRS, actually helped correct the FAQ that was originally discussing essential businesses, and that is not correct. Federal, all credit unions, essential or not, are eligible for this credit. The preponderance of the discussion we have with CPAs is that, as a CPA, they tend to want everything to be driven specifically by math. The gross receipts test is, as Tom's articulated, a 100% mathematical test. Outside of that, the fact that partial and full suspension is something that is more complicated. Again, most CPA firms are having trouble finding the linkage, and this is why Synergi Partners is here. And the fact that we do provide 100% audit support and a money-back guarantee to make everyone comfortable that our insight, our specificity is what's there to bring you clarity on those questions.
And I'll add to that too. The CPA community is a tremendous referral channel for us. But of course, we don't have the bandwidth to meet with every CPA firm in the country. So there are many out there that are proactively referring their clients to us. But of course, we have times like this, right, where we meet with someone and they were initially told by their CPA that they didn't qualify for this. And then I always welcome the opportunity to meet that CPA, because I have found that about 90% of the time after we walk them through this, they're like, you know what, didn't understand it. This is why you guys do what you do. I can see why they qualify. So the same reason why CPAs partner with us and refer us to their clients, not just for this credit, but a lot of other credits, is the same reason why most CPAs do not want to process payroll, but they know it's important and they refer their clients to different payroll companies.
So thank you, Tom. I would add, as Tom's brought up this slide, this is a great way to connect with us, to have organization. So if you would focus on utilizing this slide as a way for us to have organized follow-up, it would greatly enhance our ability to get to you and get to you quickly. Katie, I saw a question.
Got another question here, and I'll also add, since really first quarter of this year, One Digital has worked with credit unions across the country in partnership with Synergi, and has gone through that diligence process and made the employee retention credit determination and eligibility. So we've got a lot of momentum behind us as far as this opportunity for credit unions. So I think we're, again, I think as Tom and Brad mentioned, we're really not in new, in uncharted waters here. There's a lot of credit unions that have gone before you. So I think there's some, some weight to that. So in the chat, I've got a question here. Do we have to wait until the funds are received to take credit, or do we treat the funds like a grant and take the credit once the 941 is filed? This sounds like a fund accounting question. You want that, Brad?
Sure. So again, general guidance is all I can give you, but specifically, this is, again, as Tom's articulated, a refundable above the line credit. For every 941X that is filed, you would get a specific check from the IRS. That would be how you would receive the majority of the times the cash, since for every time period we're talking about at this point is retroactive. And so again, most credit unions are waiting until they actually have the cash in hand And then upon receipt of that cash, they're determining how they're going to be spending it within their credit union or within their community.
Great, thank you. I don't have any other questions in the chat or the Q&A. If there's no other takers, I think we're good. This last slide, this is the way that you connect with Synergi Partners directly under the leverage umbrella. So you get the preferential pricing that we have negotiated on behalf of leverage with Synergi. And for any follow-up questions, a service agreement, just to really be able to start the process directly, that URL link is dedicated to leverage.
Well, I just want to thank Leverage and One Digital for giving us the opportunity to help educate. As Tom's articulated, this is all based on your own facts and circumstances. And through that link, we'd be happy to have dialogue to articulate further your potential for qualification. Thanks so much, Tom. Any last comments?
This is
No,
Alan.
so I would like, go ahead.
No, go ahead.
Yeah, I just wanted to thank everybody as well. Really appreciate your time this afternoon.
And I'll just wrap it up by reiterating that we thank everybody for their time. We have recorded the session, so we will be sending out a further communication to everybody so that they can review this session again if they'd like. I believe we'll get the presentation and send that along with the link that you see on your screen here so that you can fill out the communication form there and start the process. So with that, I would like to thank our presenters once again. Thank you so much for your time and truly a great presentation on this. I'll thank all the credit unions for your time this morning as well, and we will call it a day. Thank you very much.